Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. And on the show, let's talk about the volatile and influential oil and gas market. Recently, crude oil prices have been fluctuating, with WTI crude futures holding above $81 US per barrel. That's up about 13% from the beginning of the year. So why are these prices so high, and what does it mean for our economy in everyday lives? Global oil demand is projected to grow 1.1 million barrels per day, though at a slower rate than previously expected. Meanwhile, countries like the US, Brazil, and Canada are boosting their production to balance the market, while OPEC Plus continues its production cuts to keep the prices stable. Now, this delicate balance between supply and demand affects not just energy costs, but also the broader economy, influencing everything from transportation and gas prices to consumer goods prices. Let's break it all down. Our next guest is an expert in oil and gas. Let's welcome Rory Johnston, founder of Commodity Context, a great newsletter packed with some great information and highlights about the sector. Hey, Rory, thanks for coming on the show.
Thanks for having me.
I want to jump right into this because you and I were chatting a little bit just previous to the interview, and I find when I talk a little bit about oil and gas, I lose the audience a touch. So let's pull it back and give a little bit of a macro here. Let's start with the current state of oil prices. As I mentioned, sitting around that $81 per barrel mark. It seems quite resilient here. Now, we know that we have a war between Russia and the Ukraine. We got the tensions in the Middle East. This has put some pressure on prices. But I'm curious, talk to me about oil pricing here. What are the main factors pushing the prices, and what are we going to be seeing here in the next couple of months?
So the market right now is in this kind of wait and see moment. And the challenge is that while conditions have been reasonably tight, the easiest way for people to kind of check to see in any given moment whether or not the market or the kind of broader market is perceived to be tight in the physical sense is to look at the shape of the futures curve. So for oil, whether that's Brent or WTI, I typically focus on Brent because it has less kind of U.S. specific things affecting it. But the Brent kind of backwardation or the premium on prompt deliveries is your indication that the market is tight in any given moment. And what we see right now is that backwardation is back to the highest level since April. So we've mostly erased most of the past couple months of kind of beleaguered pricing. Crude contracts right now, as you were saying, Brent is around $86 a barrel today, which is a nice high level. And I think what's particularly notable about that is that if you look at, let's say, U.S. oil inventories, which are the ones that I think most people look at most frequently, the weekly data published by the EIA, those data have actually been reasonably negative over the past month and a half. Inventories have risen faster than expected, both crude and key refined products like gasoline and diesel. But despite that, as you noted, the market still looks pretty tight, and I think expectations are that things are going to continue to tighten. When you look at the forecasts from the three major oil watching or oil forecasting public-facing agencies, that being the International Energy Agency or the IEA, the Energy Information Administration in the US or the EIA, and then obviously OPEC, which has its own monthly report. All three of those agencies expect, given that OPEC is going to continue its production cuts as currently planned, at least for the next 3 or so months, that the third quarter of the year is going to be in a reasonably sized deficit of some level, and I think tighten the market even further from here. So I think that is the main thing that's holding things together right now. I think the bigger questions, and I think the longer term trajectory is far more uncertain, given very wide differences between those agencies about where we see things going after this next quarter.
Yeah, it's certainly interesting. I mean, given the persistent volatility, as we kind of talked about, there's things that happen in the world that push prices to new levels. I mean, we had this recent attack on oil infrastructure, the Russian oil refinery incident. I'm curious, do you think that there are any signs of the market stabilizing, or should we continue to expect these types of fluctuations when it comes to pricing here?
I would say actually right now we're in a reasonably stable range. I think so. Yeah. Even over the past month or so, excluding the sell-off that came immediately after the OPEC Plus meeting, and that was at the beginning of June. Aside from that, we've been kind of in this low 80s on a Brent basis range for a while. I think we're currently, as of today, to the higher end of that range, but I have no doubt that we're going to bounce back to the lower end of that range because that's just what we've been doing. And I think until we see a definitive kind of breakout on fundamentals, by which I mean kind of further deterioration in U.S. oil data, or the EI data and inventory data, or kind of, I think what the bulls are hoping for and what the kind of current projected balances imply, which is that data turns much more bullish, and we start to see not just a seasonal downturn in stocks, because now, oil refiners are going to be running higher. We're going to have less crude in storage because of driving season. But so the expectation is not just that we decline seasonally, but decline faster than seasonally. And if that doesn't happen, I think then we're going to head lower from here.
Okay. It's such an interesting, fascinating market because it seems like every day it kind of changes. Global oil demand is expected to grow by 1.1 million barrels per day in this year, in 2024. But it's a little bit slower than previously estimated. So I'm kind of curious, we look at the oil market and a lot of it is about the supply and demand dynamics. How do you see the balance between supply and demand affecting the stability, especially with the significant production increases from the US and in Canada?
Yeah, so I think, and again, I'm probably going to anchor a lot of this in the perspective of OPEC, because I think right now OPEC has an outsized role in this oil market, because it's excluding the COVID cut in 2020. Right now, OPEC is withholding more oil from the market, or in other words, supporting the market more than it ever has since the global financial crisis in 2008 and 2009. And that's despite the fact that last year demand grew really, really strong, more than 2 million barrels a day. But now, as you noted, the IEA and the EIA expect that demand to fall to nearer 1 million barrels a day, or about half the pace of last year. That's not completely outside the norm over the past kind of like 10, 15 years, even if maybe a little bit higher, 1.4, 1.5. But still a reasonably strong kind of demand backdrop. The challenge is that non-OPEC supply has continued to ramp up considerably. Obviously, last year, the U.S. shale production, which was expected to grow by less than 1 million barrels a day, ended up growing on a total liquids basis by about 1.5, 1.6. You also had major growth and continued structural growth from other countries in the Americas, most notably Canada, where I am in Toronto, in Guyana and Latin America, and in Brazil. And both Guyana and Brazil are adding kind of structural big chunks of this offshore production to the market that isn't especially price sensitive, unlike U.S. shale is. And I think what last year OPEC had been expecting, particularly U.S. shale production, much like everyone was expecting, the growth to be far weaker. So what you got was stronger than expected U.S. production growth. And then on top of that, you also got a huge ramp up in Iranian supplies. And while Iran is a member of OPEC, because of ongoing sanctions, it's not currently subject to the group's quotas. So you had about 700,000 barrels a day of additional supply from Iran as well. So that kind of drowned all of the tightness that would have come from that strong demand growth. And now OPEC is left holding this gigantic bag of cuts. And that's why I say that it's really up to OPEC as to what the market looks like right now. Because I said, as I mentioned, the market is fundamentally tight, but it's tight by policy choice rather than by organic kind of market fundamentals. And if OPEC was to release all of the oil it is kind of holding back, it would be a tremendously bearish market. The only thing that's holding that back is their desire, and particularly the Saudi Arabia's desire, to have a higher oil price to fund its budget, its outsized budget expenditures as part of Vision 2030 and all the rest of the stuff you're seeing MBS roll out in Saudi Arabia.
Yeah, Rory, you mentioned it. I mean, OPEC Plus has been extending its production cuts, as you just kind of talked about, and obviously they're in place to stabilize the market. But how effective have these cuts been in maintaining price levels? I mean, is it more of a manipulation on pricing? Do you foresee any changes in their strategy in the future here?
I think, some people will call it manipulation. OPEC will call it management. And I think, two things of the same word. I think I have been quite sympathetic to OPEC's market management role in the past. I think the challenge it has faced over the past 18 months of the current round of production cuts is that they're trying, in my humble opinion, to maintain and support a price that is far too high. When you looked historically pre-COVID, OPEC was trying to defend and support a price of around, the mid-high 50s, maybe low 60s, up, as high as 70. Now, when you saw OPEC begin this latest cutting round at the end of 2022, Brent cruise prices were above 90. So you have a much structurally higher kind of revealed preference of OPEC. And I think the challenge of that is that at $90, US shale is still making money. You still have a general weight on the global economy. You have these things that Saudi Arabia in particular didn't love in the past. Saudi Arabia, for those who aren't aware, it has historically, ironically, been the price dove within OPEC. It's wanted lower and stable prices so that it could have this long-term game, versus others that just wanted to kind of fill their budget holes. Now Saudi Arabia is much more in that latter camp. It needs the money, it needs the income, so it wants to defend a higher price. The challenge with that is that historically, OPEC, if it's tried to defend a higher price for too long, it ends up in this exact position it's in, holding way too many cuts and losing market share. The downside of that is that unless OPEC can manage these barrels back into the market gradually and carefully, the risk is that you have a kind of a very rapid deterioration and kind of unraveling of the OPEC plus deal, and then you have upwards of 4 to 5 million barrels of crude dumped back onto the market, which would easily push us down into the 50s or below. The challenge is the issue with that is that they would also not love that. I think least of all. So that's the issue that we're trying to square here is how can they get these barrels back into the market in a sustainable way without tanking the market? And the longer the production cut goes on, the higher the probability that something kind of bad happens.
Yeah, Rory, I mean, our audience knows, obviously, it's a kind of a cyclical approach when it comes to commodities. We've seen prices in the past few years kind of maintain interesting balance rates, and that's offered a lot of buybacks for a lot of oil and gas companies on the share side. I want to talk a little bit about equities. Given the current market conditions, are these stocks still a good buy for investors?
So I don't focus too much on equities. I focus specifically on the commodity market itself and the kind of underlying commodity of crude. That said, as you can see from the fact that these companies continue to grow production, they are obviously making money at these levels. And I think that, again, from the perspective of OPEC, is the challenge that at $90, companies in the oil sands, companies in the shale patch are making a lot of money. Even excluding what we're seeing just at the crude side, you've also seen a structurally elevated level of refined product margins as well. So what we often follow in the oil market are called crack spreads, and very simply, that's like in the most simple terms, it's the difference between a barrel of gasoline and a barrel of crude oil that's required to make the gasoline, or it's a proxy for refinery profitability. Those crack spreads have been elevated since 2022. And I think that has also provided a huge kind of support, particularly the integrated, larger oil companies that have large refining assets that pre-COVID were typically a structural, drag on their profitability. Now, however, I think one of the big warning signs that we're seeing in the market is that those crack spreads, those refinery margins and refinery product kind of structure, that backwardation or contango I was talking about in the crude context, also you see that in refined products, and those aren't flashing particularly positive signs. You're seeing a lot of new refinery capacity come on, which is good for crude demand, but bad for product kind of balances. So you're seeing all of this stuff kind of playing out. And I think the moves here for those that kind of find it, difficult to follow, there's more happening in the oil market now than there used to be. And I think we're still feeling the kind of echo effects of the historic explosions in both crude and I think even more kind of acutely refined product markets through COVID, particularly in 2022, when you saw gasoline and diesel crack spreads, which are normally kind of like $5 to $15, maybe $20 a barrel in a good year. In 2022, they hit $60, $70, $80 a barrel. So you had this massive explosion in the market, and a lot of those signals are still working their way through very slowly. So I think it's difficult to follow, but all these little kind of breadcrumbs lead us to kind of where we see it right now, which is tight in the kind of on an overall basis. But I think with this very murky future, and again, this outsized dependence on the stick handling kind of execution of OPEC.
Yeah, you look at the equity side right now on the oil and gas players. As you mentioned, a lot of these are dividend players, and they're doing quite well with oil at these prices. Finally, Rory, looking ahead, I mean, what are the biggest challenges? You talked a little bit about there, but what are the biggest challenges and opportunities that you see for the global oil market in the coming months? I mean, we have a lot of things coming up. We have elections, we're in wars. What do you think is going to be here?
I think the U.S. presidential election is going to have a huge kind of impact on the overall market, not just oil. But I think the way it specifically plays into oil is that obviously Trump relative to President Biden, if Trump wins in November, you could see a reapplication or a retightening of sanctions on Iran. And I think given that what I was saying earlier about Iran being one of the largest, and it was the largest non-U.S. source of supply growth last year, that means that there's also a lot that can be cut back with a tighter sanctions enforcement. Now, I think that could be this kind of bullish catalyst for the market if you were to see 700,000-800,000 barrels a day of reduction in Iranian exports. I think the bigger challenge is that you have this massive difference in outlooks even this year and next. You had mentioned earlier that the oil market is expected to grow about 1.1 million barrels a day in demand this year. That is the IEA and EIA's rough forecast for demand this year, whereas OPEC expects it to be more than twice as fast, about 2.2 million barrels a day, which would be another hugely bullish kind of demand backdrop. But the challenge is that these views are so divergent, not only for this year, but the IEA recently released its oil 2024 report, which is its medium-term production outlook. And for the first time in the history of the organization, you actually saw them put a peak oil demand in the forecast outlook of 2029. Now, when you look further out, that is still kind of a flattening rather than an absolute kind of collapse. But it differs greatly from what we see from OPEC, which doesn't see production or doesn't see demand peaking really at any point over the coming decades. That difference creates a lot of uncertainty for those hoping to and those wanting to invest in new upstream and production assets. So if you're, the bear case for the oil market right now is that transition is happening. You're going to see a slowing of oil demand growth, and then OPEC is never going to be able to return these barrels in an orderly way. So it likely means that prices have to go lower in order to balance that market. The bullish case on the other side is that given this expectation and this uncertainty about the future outlook for oil prices and oil demand, there will be far less appetite to invest in upstream production assets, which means that we could have far too little production growth between now and, let's say, over the next 5 years. So I think it's those two competing views that we're stuck in. And I think right now, given the volatility we're having in markets, you're seeing kind of who is declaring victory on that narrative changing every couple months, basically with the latest trend in the price of oil. But these are still much larger structural kind of trends that we're trying to understand, and we haven't seen which way they're going yet. We still haven't really. We don't even know where global flight demand is going to go in terms of a post-COVID recovery. We just don't have enough time yet, and the behavior hasn't been revealed.
Yeah. I mean, it's interesting, a lot of it political chess games as well. Hey, Rory Johnston from Commodity Context joining us today. Thanks again, Rory. You broke down some important facts here and you cut through the noise. So we appreciate taking the time coming on today.
Thank you so much.
Thank you. I'm Jeremy Szafron. For all of us here at Kitco News, don't forget to hit that notification button. We got more great content coming this week, and we'll see you next time.